Does investing in the Bajaj Allianz lifelong life goal plan help you achieve early retirement? Let us see in detail in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decisions so that you can achieve your goals faster and smarter. Bajaj Allianz Lifelong Life Goal Plan is a non-participating life individual whole life unit-linked regular premium payment and endowment plan. In this video, we are going to see its features, the types of investment strategies it has, the types of fund options, benefits, various charges available in this plan, advantages, disadvantages, benefit illustration through the IRR analysis, and whether it's a good plan compared to combination of term insurance plus PPF or ELSS, and finally if you should choose this plan or not. We are going to see all of these things in detail further in this video. Now let us look at the features of this policy. There is a choice to choose from two plan variants. One is long life goal without waiver of premium, and next is long life goal with waiver of premium. And the second is you have the choice to choose from 4 investment portfolio strategies and also 10 fund options to choose from. And every year from the 5th policy year till the 25th policy year, loyalty additions are added to your fund value. And also the life cover charges and waiver of premium charges you pay will be actually returned to you at the end of the term period of this policy. And also the retired life income till the age of 99 years with the return enhancer and whole life cover is provided. You also have the option to reduce your premium amount after your post lock-in period. Now let us look at the investment strategies available in this plan. There are 4 investment strategies. The first one is called the investor selectable portfolio strategy. If you want to allocate your premiums based on your personal choice and decision, you can opt for this strategy and choose from the 10 funds that are available in this plan to suit your investment needs. The second one is called the Wheel of Life Portfolio Strategy 2. In this portfolio strategy, at the commencement of the policy itself, the regular or limited premium and the top-up premium, if you have opted for any of those premium amounts, would be allocated in the funds mentioned, namely like Equity Growth Fund 2 or Accelerator Mid-Cap Fund 2 or Bond Fund and Liquid Fund in the proportion which will be mentioned in the policy brochure, which you can refer, depending on the outstanding years to maturity. The third one is called the trigger-based portfolio strategy. Under this portfolio strategy, regular or limited premium and top-up premium, if any you have chosen that, will be allocated between the two funds, Equity Growth Fund 2 and Equity, which is an equity-oriented fund, and a bond fund, which is a debt-oriented fund, in a 75% to 25% proportion. Finally, the auto transfer portfolio strategy. This strategy helps you to invest your money systematically by automatically transferring your money every month from a low risk fund to the funds of your choice. So as you can see from the screen, there are various fund options available. Like totally there are 10 fund options, and every fund option varies in risk. Like some funds are 100% exposed to equity, some funds have a very low exposure to equity. So like some funds are very risk free, some funds are very high risk. So it all comes down to how much risk you want to take and what kind of risk you want to take according to your investment need. So according to your risk appetite, you can choose from any of these funds to suit your investment needs. Just like any other ULIP policy out there in the market, this policy also has various charges attached to it. First, there is something called premium allocation charge, which ranges from 3 to 6%. But this charge will not be charged for someone, some policyholder who has an annual premium of 10 lakhs and above. And also, there is something called policy administration charge, which is not charged in this plan. But the thing is, both these charges are just charged for entering the plan. For compared to mutual funds, there is no exit or entry charges there. But in a ULIP, there is always an exit and entry charges here. Even if there is no policy administration charge, you can see that the premium allocation charge itself ranges from 3 to 6%, which is an unjustifiable charge. You don't need to pay just to enter the plan, right? So now we come to the fund management charge, which ranges from 0.50% to 1.35%. But this is a justifiable charge because it takes effort to manage your funds. So to charge for that, it's completely justifiable. And also there is something called mortality charge, which is charged to provide you with life cover, and it depends on the age of the life assured till the policy term. So it depends on those factors, but still mortality charge and fund management charge is a justifiable charge. And again there is something called surrender and discontinuous charge, which I have mentioned before. In if you take mutual funds, there is no exit or entry charge, but in a ULIP, like there is a exit and entry charge. Like for entry you have the premium allocation charge. For exit, like surrender or to discontinue the policy, you have to pay. But the charge depends on the time of discontinuance and the annual premium the policy holder has taken for this policy. But whatever the factors are, it will not be charged from the 5th policy year onwards. But before that, you still have to pay. So having a charge for entry and exit is not justifiable, because in mutual funds at any time you can leave. For entry and all you don't have to pay, but here there is a certain amount of time you have to stick before you have to discontinue, otherwise you will be charged. It's not justifiable. Also there is something called miscellaneous charge, which will be 100 rupees, which it will also be charged. So out of all these charges, only two seems to be justifiable. So these charges also bring down your overall return. That's why ULIPs they do not provide with very better returns in the long run, because these charges itself bring your overall return down. So okay, now let us see what are the advantages to this plan. So as I have mentioned before, there are 4 investment strategies and 10 fund options available to choose from, and also there are partial withdrawals which are allowed post your lock-in period, and the death benefit and maturity benefit provided in this plan can be taken in installments. And the mortality charges are returned to you at regular intervals. So it's not something which will not be returned. When you pay it, it will also be returned back to you at regular intervals. And the loyalty additions they provide you with will also enhance your fund value. And each RLI installment will be hiked up by 0.5% every year. Now let's look at the disadvantages of this plan. First, the net premium, which the net premium you invest in this plan will not be invested in your chosen fund option on the get-go. It will be invested only after the deduction of charges. So basically, they will not deduct the charges from it after investing and from that return. They will deduct it before investing itself. So overall, it also will be a factor on bringing your overall return. And then the lock-in period for this policy is for 5 years. So 5 years you cannot surrender or discontinue without paying a huge amount of charge for that. So another thing is the loan option. The loan option is not available here. And the top-up premium, like the option to top up your premium, is not available in this policy. And also the mortality charges that are deducted from your premium are added back to the fund later at a later stage, but without considering the time value of money. The same amount of money you're investing now will have a different value. All the details we just looked into are just factual, and you can find that on any policy brochure of this plan. But what we need to completely understand before investing this plan to see whether it will be a right fit for your investment portfolio or not is if it will bring a good return in the long run, which we can see with the help of a benefit illustration. So first we will figure out the internal rate of return of this plan, which we can compare it to other investment vehicles available in the market to see whether they provide us with better returns than this plan to make a informed decision. So let's assume, to calculate the IRR of this plan, that 35-year-old male has opted for this plan. So with a sum assured of 10 lakhs with a premium paying term for 20 years. So his policy term is 99 years of age, which is like 99 minus 35 is equal to 64 years. And the annual premium he has to pay for 20 years is 1 lakh. And the plan option he has chosen is without waiver of premium. He has not opted for RLI, and the fund option he has chosen is pure stock fund 2. So his life expectancy, let's just assume it's for 65 years. So we are going to calculate the IRR with the help of a benefit illustration that we have taken from the Bajaj Life website. So there they have given the assumed rate of return for the fund. This fund is in the worst case and best case scenario is 4% per annum and 8% per annum respectively. So the returns indicated at 4 and 8% are only like for illustrative example. It's not guaranteed. And they are subjected to the policy term and conditions, and they do not indicate this is the higher limit or a lower limit of returns under this policy. Now, if you see the table on the screen, see he has invested for 20 years and he has to stay invested for further 10 years. But the final value you can see on the screen is meager because the IRR at 4% return is 2.39%, and the at 8% return, assumed return, the IRR still comes around to 6.26%. So it doesn't make sense to invest in Bajaj Allianz lifelong gold plan because the bank of FD deposit will itself yield better returns compared to it. The value for your money, the time value for money is not worth investing for 30 years because it's not coming anywhere around it to make it a worthy investment. Also, it does not aid to combat inflation in the long run because whatever cost you have for certain things, it will be the cost of those things will be inflated in 30 years obviously. So in this meager return you can't combat inflation also in the long run. Also, like 2.39% is just if you do not invest your money anywhere and you just invest that keep that money in your bank account, even that savings bank account rate of interest will be higher than this. Even in the best case scenario, it is not coming anywhere near a good bank FD deposit return. So I don't find it a worthy investment. But before concluding it that way, let's see if there are other investment alternatives in the market which can provide us with better returns than this policy by investing in the market itself. Or even let's assume like if a risk-free product also can, if it can better provide us with a good return. So let us compare it with both risk-free and a risk product just to see how it fares. So to compare, first we need to consider the life cover. Because Bajaj Allianz does not only provide you with investment purpose, it also provides you with life cover, right? So for that, we are going to invest in a combination of pure term insurance policy plus another high risk and low risk investment instruments for each to compare. So because pure term insurance policy will serve the purpose of providing with life cover, and for investment purpose, we can choose to invest in both high risk and low risk just to get a good comparison. So first, the investor can choose according to their risk appetite. For pure term policy, the one we are going to choose has a premium for 5,500 rupees for a 10 lakh sum assured, the same given in the policy. And the balance amount of 94,500 can be invested in other investment products like PPF or ELSS because PPF is a risk-free product and ELSS has risk components to it. So finally, if you see the table, the value you get at the end of a 30-year investment period is 83 lakhs for PPF and 2.15 crores under the ELSS option. So the IRR works out to be 6.83% for PPF, which is a better yield compared to Bajaj Allianz best case scenario, because even in the best case scenario, this plan only provides you with 6.26%. A risk-free, a complete vanilla product like PPF itself can beat it with 6.83%. The thing is, Bajaj Allianz has risk in it. Whenever we take risk or to invest in a risk premium product, we take it because in the long run, we think it will help beat inflation. It helps us to beat inflation. We invest in a product which has risk only to gain more better return and to beat inflation. But a risk-free product like PPF itself can give you with 6.83% in the long run, which this plan couldn't. And if you take the ELSS option, the IRR works out to be 11.29%, which is a post-tax option. And also this is also a better yield, and this one can definitely beat inflation in the long run if you consider it. So the ELSS option can help you to accumulate wealth for your life's financial goals, which is our main agenda of investing anyway. So comparing both PPF and ELSS to the Bajaj Allianz lifelong life goal plan, it is evident that these both high risk and low risk investment products, which are already available in the product with a proven track record, can beat Bajaj Allianz best case scenario without a hitch. So finally, if you see if you should invest in this plan or not, whether it would be a good fit for your investment portfolio or not, we have to consider it's not, because this plan, the Bajaj Allianz lifelong life goal plan, does offer an opportunity to invest in the market. At the same time, it also provides you with life cover, but it's a market linked product which does not give you any guaranteed return, and even the potential return is not on par with other investment products available in the market. So from an investment perspective, it is not a lucrative option. If you opt for the retired life income RLI, then the income from the Bajaj Allianz lifelong life goal plan won't be sufficient to meet your post-retirement expense. Also, the sum assured provided in this plan is not adequate. So it has the potential market return, linked returns, but is not on par with other investment instruments, and also the inbuilt charges makes them insufficient. The inbuilt charges also brings your overall return in the end. Also, there is liquidity issues for the first 5 years, and there is no loan option available. So in case you want to use this money for any to achieve your short term financial goals or for any emergency needs, you can use that, because there is liquidity issues for the first 5 years and there is also no loan option. So the potential return we get from this plan will not beat inflation consistently. So I think it's better to avoid this plan and invest in other investment alternatives like we have discussed before. See, if you do not invest in the appropriate asset class, then you're essentially allowing inflation to take away your hard-earned money from you. So it's better you take your time and choose a better investment option according to your risk appetite and the time horizon within which you want to achieve your financial goals. It is always wise to keep your investment and insurance separately, because that way, in that combination, if you invest, it can yield you better return than a ULIP plan like this. So if you want to understand more about this plan, there is a detailed blog post about this plan on our website, which we can find in the link in the description. If you have any doubts regarding the topic we have discussed in this video, please comment so we can get back to your queries quickly. Also, if you have any doubts regarding mutual funds or any insurance policy in general, then you can always book a complimentary financial consultation with one of our financial planners to discuss about it, and the link is in the description to book your appointment with us. And if you want to gain more knowledge regarding financial investments and personal finance in general, we also regularly conduct live webinars for which also you can register by clicking the link in the description. Also, if you like our content, please like, share and subscribe to our YouTube channel. Thank you.